don't think cyber, I'm going to say, will ever be cheaper than it is today.
Welcome to the Voice of Insurance. I'm Mark Gagan. The voice you've just heard is Dan Trueman, Global Head of Cyber at Axis Insurance. Now, unless you really haven't been paying attention, cyber insurance has been the global growth story of the last decade. In fact, it's grown so far and so fast that there are really very few people who you could identify as market veterans. And that's because hardly anyone's been working in the class for long enough to qualify. Luckily enough for you, Dan is one of the true market pioneers with a 20-year career that has always been centred on insuring unconventional enterprise risks. Dan's an expert and a cyber evangelist. He wouldn't say it, but he's effectively an industry spokesperson and an ambassador for the cyber class globally. You'll also find that he's not only very smart and polished, but he's also really good company. In our wide-ranging discussion, we got to the heart of what has triggered the explosion in cyber growth. We talked about the latest in price, demand, and loss trends. And we also dissected all the innovations around cyber modelling and the work that's going on to maximise the reinsurance and alternative capital that can be brought to bear on this potentially systemic global risk so that its growth story can continue. We also looked at regulation and the thorny issue of silent or non-affirmative cyber cover, as we call it. I really enjoyed our talk, and I'm sure you will too. My first question was to ask Dan to tell you a bit about himself, how he got into cyber underwriting, and what Axis is up to in the space.
I was really lucky. I suppose when I first started the industry 20 years ago, ones and noughts and the challenges they have were still sort of emerging. I mean, we were going through Y2K at that point. So cyber risk itself.
Were you at, was that Kiln, pre-Tokyo Marine?
In those, pre-Tokyo Marine. And I started classically as a graduate trainee and did what was at the time at Kiln, we did lots of 3-month rotations. Became very experienced filing clerks, and I was really lucky, and I settled with a couple of actually fantastic bosses. Charles Franks, Robert Chase, and Paul Cullen, particularly actually at Kiln at the time. Really, I was taken under their wing and became a political risk underwriter, and really luckily didn't sort of focus purely on political risk and looking at but actually started focusing on supply chains. And looking at what was the product at the time, trade disruption insurance. And what we'd done there was change sort of the concept of insurable interest from sort of physical loss, physical damage to an asset.
I was looking at your LinkedIn profile and it said enterprise risk, which of course was a classic sort of forbidden fruit of insurance.
And it's exactly that. It was to try and look at this idea of actually changing it from what actually keeps businesses awake at night. Can I generate revenue? To what businesses are told to keep them awake at night. Are the bricks and mortar going to survive around me? And as we know, that's the same story we're seeing. It's great playing out in the world now, and hence cyber underwriting becoming so. That bricks to clicks type of issue was the same thing we were facing as an industry. And I think one of the reasons I think this is such an amazing industry, and it will always have relevance, we know that because businesses can't take on risk without the social value of insurance being there to protect them. But I do think we need to keep innovating and keep supporting as an industry that fundamental concept, which is what are the risks that businesses are facing. And it isn't always, you Mark, we've just been discussing, no longer need to be wedded to an office to be able to produce what you're producing. That's a great, in a microcosm, what we're seeing around the world. And so as people are more and more, reliant on the ones and noughts in order to build and generate things, fundamentally, the risk they're facing is the same. And so that's almost in a microcosm has been my journey in insurance, has been as that risk has emerged. We initially called it enterprise risk, and within the enterprise risk we weren't just looking at the cyber, we were looking at reputational risk in its first instances and trying to look at that as a business interruption type risk, and also looking at intellectual property. And
because I remember as a broker, coming in as a broker in 1992 and seeing this little dusty policy in the corner that said computer crime, and I thought it was really exciting because I was just a recent graduate. I thought, wow, this is amazing. what is that? And someone said, well, yeah, we've never sold one of those in 100 years of having it. And but when was actually the point when you saw that cyber was going to work as a product line, and you'd start calling it cyber when you'd sold something substantial, and you were suddenly on risk, and you thought you suddenly had a business?
And I think that's, again, so there are a number of sort of key moments in the cyber journey. The first key one is a piece of legislation called Graham Leach Bliley, which was enacted in 1999, which was the first sort of fundamental. We've all had a common law right.
That sounds like a US.
That is a US piece of legislation.
Because they always have two surnames, don't they?
Yeah, they keep sort of adding them through, and whoever sponsors it through gets it, But this, again, like, we all have a common law right to have information kept private. That's been enshrined, I suppose, for us, certainly since, various the government was heavy-handed in sort of the late 1600s. We've had that within Constitution. The same thing within the amendments within the US Constitution guaranteeing the right to free speech. Exactly the same sort of fundamental background. When the government overacts, so does the law in terms of enshrining that right. So that's existed. But for the first time, what actually happened was encoded within statute was this idea that personally identifiable information. So information that defines a person, their name, their social security number, ID number, passport number in our instance, is personally identifiable. And if that is breached by an organisation, not only is there a common law right to deal with the liability of that breach, they actually had to do something about it. For the first time legislation, so that was in 1999. So that sort of created this idea. I admit at the time we were still focused, in my background at Kiln, really on the first party elements. What is the loss of revenue? So not that privacy, sort of I have to use that word because obviously privacy depends on what side of the Atlantic I'm on. It's one of those, nations divided by a common language moment.
You can say privacy here, it's okay.
Thank you very much. Just checking in case your international listenership. So we had this sort of classic idea. Then in 2004, the same sort of act was encoded within healthcare within the US, what was called HIPAA, Healthcare Information Privacy Protection Act. And that sort of that was, I think, always sort of marked that as the real kickoff, that we had a market. So suddenly, not only was it financial institutions had to look at their personally identifiable information, now healthcare organisations had to look. And by definition, both of those types of organisations carry quite a lot of private and sensitive information. So they, and particularly in the US, and this is the classic challenge, and this is one of the reasons why this market in London has been so successful, is because we've always taken risks from the US and transferred it. In the development of privacy legislation, it's a classic example of the US sneezing and the rest of the world eventually catching that cold. I mean, we've got the flu.
Is the cold GDPR then?
I think that's the flu. I think GDPR really is something sort of rather more aggressive than a sort of mild head cold, and rightly so. We'll come back to that in a second, but this idea of legislation creating the market is really key, because it does enable organisations to start looking at their own risk and understanding that the government's legislating about it. The reality is, I think cyber is going to continue to grow as organisations themselves work out what they need to do outside of legislation and look at their own business models and understand that they need to re-look at how they're transferring their risk.
Yeah, I mean, how does it stack up at the moment? Obviously, you mentioned about that you were looking at first party sort of loss of revenue, effectively business interruption type stuff. You talk about effectively describing breach response, which we know that Beazley really took up and ran with, and that was the first time as a journalist that I saw something that had the word cyber in it. It was in a Beazley analyst presentation, so it had quite a big number attached to it. It was about 6 or 7 years ago, the first time that I thought, oh wow, we better pay attention to this. And then how much is actual genuine liability business of within cyber? So how do each part sort of stack up the kind of the statutory sort of duty to inform people there's been a breach and sort of try and make good in some way, the liabilities of perhaps the software engineer who caused the breach in the first place, or somebody who did something wrong, and the first party. Do you know how does it stack up out of the 100%? How much is each?
Obviously, there's an allocation of each. I think the challenge is there's always been this really uncomfortable relationship within cyber between this idea of first and third party. You hold someone's information, you thus create a liability in hold of that information. The reality is the statute tends to look at notification as the way to rectify any breach. Doesn't, yes, in the fullness of time, if there are actual damages, which have proved quite difficult to prove, then the state's attorneys general in particular have been very interested in finding some way to sort of fine and punish people. So there's a liability held there.
And is there a lot of and you're able to cover a lot of these fines?
Yeah, within the US in that situation, there is coverage. GDPR is much more problematic because underlying legislatures still deem fines and penalties to be contrary to public policy. So that typically is the way we have to look at that. I always think there's the classic comma where insurable by law is not an exclusion by proxy. It's keeping us out of prison. Is the point? Is in many instances we are not legally able to cover certain things, and I think that's always a really important sort of point to make. I think what I've just really important to come back to the idea of what the coverage. In most instances, it costs a lot of money to notify people. I mean, there has been, thankfully, in certain instances, some claims deflation.
How many sort of dollars is it per head? Presumably, if the higher the number, it does go down. I presume you get some economies of scale, right?
Yeah, and by definition, there's a range, and it again depends on the total population, the number of people that actually. So typically, you have to tell them there's been a breach, and then offer them some form of rectification. Not all people will always take up that, and particularly we're sort of at a breach lassitude point in certain instances. That's almost the sort of the other side of this effect, with everyone being notified of every breach, and that actually a lot of people have been notified of a lot of breaches now, which is a problem. And this is the point, is the disappointing fact of all this is organisations aren't necessarily changing their habits, keeping information more secure, or fundamentally still putting the right protections in place. And we see such a range of behaviours. I mean, the best ones are phenomenal, and the worst ones are still sort of really quite problematic.
Let's sort of really get stuck into the state of the cyber market today. Obviously, the product's been taken up. It's been the growth story of the last 5 years. Every young underwriter's probably wanted to go and become a cyber underwriter if they would dream of doing so as a way of getting ahead in their career. But over the last couple of years, we've had some quite high-profile losses. Ransomware seems to have been a problem. Run us through what's happening, and has there been a little bit of hardening in price as well? We're
certainly seeing price start to move the right direction. I think for a long time we had the classic sort of supply-demand curve working against us. As I would say 10 years ago, there were sort of 50 people, sort of 50 organisations probably underwriting cyber. There's now 500 globally plus. The reality is, the other frustration, I suppose, there wasn't 10 people in each of those 50, so there's a lot of people new to the market, leading teams. And one of the classic challenges, one of the reasons why we have this other supply-demand curve for the young underwriters, and they're all in there looking for careers. It's fantastic. It's fantastic to watch the talent that's coming in. I've actually been really excited by that. But we need it. There is an absolute dearth of experience in the market still, which is a bit of a challenge, which will always continue. So there is a logical, as the events are coming up, as we're starting to see more, certainly, I don't think cyber, I'm going to say, will ever be cheaper than it is today. And I think that comes from two fundamentals. One, there's, the coverage still has yet to set around a sort of commoditized basis in terms of, always new ways of looking at it, new ways to look at the underlying risk. I don't necessarily think we're suddenly going to change extremely. I think we've sort of started to come up with something, but the other side of it is, you talk about ransomware as a really good example.
I mean, how bad has it been? Has it been the loss of 2019, hasn't it? Or is it really just like a standard attritional loss now, like a trip and fall or something?
It's certainly, what's changed is back in the day, the bad guys would have to go and do quite a lot of recon. They'd have to work out what their vulnerability was. They'd have to work out who had that vulnerability, and they'd have to find a way in to exploit that vulnerability, and then they'd have to take the payload out, and then they'd have to go and cache that out. The alternative now, they go on the dark web, they find someone who's willing to sell them an exploit, a commoditized ransomware, and then they just hit that at scale, and cashing out is direct, some Bitcoin.
So these, yes, of course, I suppose these people, as technology advances, these are technological criminals, and they're advancing even as fast as they possibly can.
Agreed.
They're automating everything that they're doing. If we're digitizing, so are they.
Yeah, and so that classic. I mean, also think it's really important to point out it's not a totally asymmetric battle. I think the assumption has always been that the bad guys are always running faster. There are times when the systems catch up. There are certainly organisations that have proven themselves capable of avoiding these challenges. So it's not totally asymmetric, but you're absolutely right. I mean, fundamentally, the bad guys are trying to find new exploits.
So, would you say it's fair that we get into a maturing phase? Presumably, early days, you were making quite a lot of money, and that would have attracted the attention of other people in the market to say, "Wow, look at these loss ratios; they're fantastic." And now the loss ratio is approaching something that's far more sort of, producing combined ratios that are much nearer to 100, or perhaps above occasionally. You could say it's a matured market.
I think the reality has always been the market's had volatility. I mean, there's always been some big losses in the market. We go back to the late 2000s. We had Heartland Data Systems, TJX. There were some large losses in the market, and they weren't very big books. So I think this assumption that cyber's been this sort of always run well is flawed. And I think it's one of those things that people, good underwriters have always managed to make good money in any market, in any class. And I think, cyber shares that same issue. You still need to have fundamental sort of ways of doing things. You need to be very conscious, very focused, and keep your, what it is that is good underwriting is probably, I think one of the other things is probably more shared by cyber underwriters with all the other classes than is the difference. It's a point of parity, not a point of difference.
But is it fair to describe it as maturing in terms of the sort of income that you're able to generate now, and is that income also kind of repeatable, and you feel it's quite solid? You know that it's going to be there and renew.
I think that's
next
fair.
year, and you know that it's going to be around.
Well, I think there's two sort of fundamentals. What we looked at the legislation earlier. Most of that legislation originally focused on industries that kept sensitive information, and the two big ones are obviously financial institutions, healthcare. A lot of the breaches also then happened to retailers, so that's what we used to call the big three. So FIs, healthcare, retail, and those are the people who bought cyber because they kept all this information, and thus they had a liability. What we're now seeing is it's not just those three. If I looked 5 years ago, they'd probably be 60-70% of the book. They're now less than 45% of the book, those three. So the other industries are catching up.
I suppose I could think, just off the top of my head, I could think of a credit agency. You can talk of a UK ISP, broadband provider, and the world's largest logistical firm. So yes, it's quite varied, I suppose.
Massively varied.
And airlines and God knows what else.
Airlines, certain foreign exchange organisations. I think we've certainly seen the breaches and the places the breaches are happening isn't just in healthcare. It isn't just. Where they tend to happen, it's what we sort of call window lock theory, though, is they do tend to happen at scale and with frequency, where maybe the vulnerabilities are systemically low, where underinvestment, and the classic example is the NHS had its challenges, through the WannaCry issue, and there's a really good example where, unfortunately, if your decision is, can I invest in a new MRI system for my hospital or cybersecurity, and no one's asked me the right questions about that, well, I'm going to go for MRI because that's where
they're still running Windows XP or whatever.
And frankly, therein lies the point. Because you can't invest in a new MRI, your previous MRI is still running on software when you bought it 20 years ago. Therein lies the challenge. We talked about my early career. I was sort of thinking about that actually, funnily enough, the other day, and I was remembering systems based on MS-DOS as we would come in, and we had to, in order to move through the screens for a data entry, we had to remember 3 or 4 letter codes. That was the only way you could move from one screen to another is, remember, this was an EDDC screen. So those sort of fundamentals are still in some industries.
Obviously, there's fast growth. Growth is a great way of kind of running away from your problems. Do you think any of the fast growth, this fantastic fast growth, has it masked or hidden any underlying problems within the cyber market?
I think it's a really good question. I don't think it's necessarily hidden any issues, not with people who get it, but I think what it has done is it's allowed people to forget to invest in certain issues, and I think The really good people haven't forgotten that, and they have been looking at modelling properly. They have been looking at understanding it. They have been building across the broader value chain and not just focusing on the here's a product, here's a price for that product, And I think that's been the difference. And what worries me is we've ended up, because of that growth, the supply demand has been artificial. So there's been lots of entrants that maybe haven't necessarily added to the general positivity and the right behaviours. And I think that's more the challenge.
And is the market? Are there any potential constraints on growth? Perhaps from, I'm thinking about reinsurance capacity.
Mm-hmm.
Are we getting to that point? Is presumably demand is still up year on year, healthily so, as the product awareness becomes greater and the threat becomes more obvious and apparent day by day. But are there any potential constraints on growth? I mean, in terms of, are we going to be hitting the buffers in terms of growth? Is it also human capital as well? Both sides of it,
Mm-hmm.
actual real capital. Is it a struggle to get the sort of limits that some of these really big corporates are going to want to buy? And also the systemic event limits. There's a lot of questions all in one go. But
I was about to say, so many questions.
That'll get us done for the next 5 to 10 minutes, I think.
That's brilliant. Well, if I go off on a tangent, please bring me back on to answer any of those questions. I'll start with the human capital, because we started looking at that earlier. It is, things that keep me awake at night.
You're doing a lot of that, aren't you?
We are
training.
Desperate. I mean, we had over 2,000 people go through the course we run last year alone, which is fantastic. We developed that ourselves.
But that's you're educating your brokers as well,
massively, and our reinsurers. So in order to try and deal with that capacity, we have a lot of our reinsurers go through that course, which is fantastic. We'd rather they understand the risks fully. Same thing is, clients. We do a lot of tabletops with clients, which we've built ourselves. In fact, I came down from the team. Actually, looked like they were playing Snap, but actually what they were doing was they were distributing roles for the HR person, the CEOs, and the cards of what role to play for a role playing tabletop exercise upstairs. So we've built our own fundamental process. We've just published a book, 35 Views of Cyber. Which is fantastic. So we think this is a problem that can't be dealt with just one way of looking at it. You need at least multiple views. That came from the classic Hokusai print of the Great Wave, and the view there that actually, what people don't know, that was actually a view of Mount Fuji, not a view of a wave, and it came from a print work called 36 Views of Fuji. So we decided we couldn't go as many views as the master. So we came up with 35 views, and the idea really is to take cyber as a central proposition and move around it and see it from different angles and see what this risk is doing, whether that's at a public policy level, whether that's at a firm's own protection level, whether that's the idea of how we need to evolve the constraints, what we call the problem of the squid. And I'll come on to that.
So do you think you're keeping up with your own demand for, as you grow, to have enough staff and enough staff who are well trained enough to be able to train others, and or is it just a constant fight? Or you're getting there?
I think what's really exciting is we're able to, frankly, underwriting talent, in my view, is slightly more fungible than people think it is. This idea that if you're a hull underwriter, you're a hull underwriter for life, and some random decision you made at the beginning of your career has meant that you will never get to look at something else. We've proved that isn't necessarily the case. We think we can teach people specific technical skills about cyber that they need to know, but we can find underwriters, and there's some fantastically talented underwriters that are actually, currently as the market is looking at some of the other classes perhaps, that are looking at, at a nice moment of their career, they're willing to be looking where they are. And we brought some brilliant people through on the other side. So that's fantastic, not least with the focus the London market's looking at the affirmation of risk and affirmation of cyber risk, and this idea of, dealing the end of non-affirmative or silent cyber. It's been brilliant to have people with experience in property damage and hull underwriting, etc., come onto the team so we can actually add some value there.
Right. And what about, actual potential capacity constraints? As, we build up, you try and build towers of up to, $1 billion or whatever to be meaningful for a big Fortune 1000 customer or FTSE 100, customer. How important is, what are the advances? I'm reading every day about new investments in sort of insurtech, cyber modelling businesses. And obviously, you've got this absolutely systemic risk, absolutely dynamic risk. It's never the same. If I take a satellite image of beachfront houses in Florida, generally, you look every 2 or 3 years, there'll be more houses generally than there were last time you looked, but they're still there. They're still made of brick or whatever it is, or concrete or whatever, and I can see that it's got a slate roof or whatever, and that risk hasn't changed necessarily, other than the world's changed a little bit, but it's fairly static. But your risk is it's sort of there's an upgrade in some database or whatever, or operating system, and the patch hasn't gone out, or there's a mistake or something. It's completely dynamic all the time. How much more comfortable are reinsurers getting with the sort of event limits that they're putting out with your own reinsurance? Or are we getting close to a point where we just you would say actually we can't do any more because we can't put out any more limit?
I think, it's a really, really, it is the thing. It genuinely does keep me awake at night. Is understanding how we make sure we maximise the capacity in the market. And I think if we go back to Insurance 101, what we should learn on our, on the knee is we're learning is aggregation, is making sure we manage our exposure and aggregation, and systemic risk. Is obviously the way we define aggregation within a cyber sense. This idea that there are single points of failure that are shared across multiple organisations is something that is a genuine constraint and needs to be looked at. The challenge we've had, and it comes back to this investment idea, is understanding actually what the return periods for some of those issues are. So one of the big cloud server providers, is in reality is probably the systemic risk, the failure of one of those. What is the genuine return period? And the assumption that that's one piece of software is the flawed assumption there. So, the reason these things don't fall over every day is because they're not one piece of software. It's multiple versions of the same software. It's sharded or sent off in different ways so it can back each other up. And
I presume every company is slightly different, that they're running one thing on another thing with another thing with another thing.
Mm-hmm.
And actually, there's actually surprisingly fairly unique combinations of software with operating systems.
Right, you're going to be a cyber underwriter, anytime soon. So I think this is something not everyone. And I promised you not to get too cyber geekery here, but it's what we call logical disaggregation. The reality is everyone's running slightly different versions of the same thing.
Could I say, it's sort of like, but it's presumably it's DNA, isn't it? We're all Homo sapiens, we've got arms and legs and eyes and nose and mouth and stuff, but we all look different and everyone's different. And
I think it's the recombinative, versions of that is how those are put together. So
that's actually comforting. So we're not as systemically exposed as we thought we are. There's a lot more individuality and, vulnerability over here, but not vulnerability over there.
It's the way that's configured and what you're doing with it is the key difference. And I think that's one of the challenges. And when we look at some of these modelling firms that have emerged, for me, the focus has been too much on the front end. There's been too much of what we call, trying to solve the outside-in problem, understanding what this risk is in terms of its general profile versus that risk. What actually keeps me awake at night, we can ask questions about that, and we can define good behaviours. So actually, we're doing some work on that, and I'd love to explore that in a second.
Presumably now you do a lot of that. A lot of the tools are sort of happening. They're sort of sniffing around and doing that automatically, aren't they? Or?
Absolutely, and you can definitely picture one of the key aspects of that. Actually, when you look at one of the big things that does make organisations fundamentally better is how quickly they patch. When you look at these new patching cadence is almost one of the greatest behavioural issues. Things that patch quicker are better risks. So we can do that. We can find that out. What version of this software are you running, and how most recently was that version released? That's something actually you can find.
You're just one of these people who makes me shut my computer down every night and start in the morning, aren't you? And then it even says updates halfway through the day.
Luckily enough, your computer does this for you now. Most of these fairly basic sort of fundamentals are just press on that button, yes, and it'll sort it out for you. And I think this is, ironically enough, this is one of the advantages we see with the small, medium-sized enterprises is typically, particularly home-based businesses, for instance, they're run off, one single laptop. You're not, and you will replace that laptop. Your replacement cycle isn't the same as the NHS's replacement cycle on a CAT scanner. It's literally 2-3 years, and thus your likelihood of running an unsupported piece of software is almost minimal. And so, provided you do the basic hygiene things, actually risk can be reduced. And that's sort of actually, when we look at cyber underwriting in its sense, when you look at it at scale, it's actually reasonably easy to identify what basic hygiene looks like. Unfortunately, not all organisations are following it.
Do you think on that cyber modelling side, are we going to get an RMS sort of Equicat Verisk style, air worldwide third-party vendors coming in and sort of becoming the industry standard, or is it going to be a lot of proprietary stuff, or is it a bit of both?
I think it's going to be a bit of both. I think almost like
what's the Axis wave? Are you doing a lot of your own, right?
Literally, yeah, and a bit of both though. So you have to test it against the standardized model, because by definition we're trying to buy some reinsurance, and there's a standardized way that's been looked at. But fundamentally, while those models are still in development, we would rather test ourselves and ask ourselves the uncomfortable questions, because we believe with the investment we're making, and there's a huge amount of investment we're putting into this, and the great team that sits around this side of things is trying to understand that and challenge ourselves. Because actually I'd rather, if the answer is, by the way, this is more exposed than we thought it is, we need to put our pens away, that's a good answer to know. We'd rather know that answer and be very comfortable knowing that answer than we would the other way around, and that's always been the approach we've taken.
That's good. Well, you sound really confident, actually, which is very encouraging. So
I wouldn't. I mean, let's be, sort of not overly confident. I think that the challenge is, by definition, we don't think there's a certainty about it. We do keep testing our. It's the old Maynard Keynes quote. I define my hypothesis, and if my information changes, I redefine my hypothesis. And so what we're constantly doing is stating our hypothesis and testing it. I think that's the challenge.
On that subject, do you think we're overdue a big cyber cat sort of clash event that just suddenly, because I wanted to go back to that you mentioned about the silent cyber risk, being addressed partly as here in London, it's being addressed partly top down by the regulators, by Lloyd's and by the PRA. What about, do you think we're going to get this big cyber cat loss that perhaps, underwriters occasionally sort of wish for, perhaps, and then they regret that they ever wished for it when it finally does happen? Do you think that's going to happen?
I think, look, the reality is we're
The
pricing for it.
watershed loss that finally defines cyber has to be excluded from all the other things it should never have been included in, or was left silent in, the power plants and all the other places where it might crop up. Do you think that's going to happen or not? Are you sort of a believer in that?
I think it will happen. I think we're pricing for it, assuming it's going to happen. The reality is, it's the challenge is being consistent with what we think the return period on that event is, and I think therein lies the challenge. We certainly know there's a huge amount of potential exposure in the tail, for want of a less mathy term.
But perhaps in the world of the dark web, but surely once it's happened, then it can happen again 100 times.
Yeah, absolutely. Well, there you go. The exposure. I mean, I think the challenge is, if some of those doomsday scenarios happen, we'll all be sitting at home with baked beans, and it won't happen the next day.
No, you're probably right. So in general, you're happy that you're staying relevant to your clients, that the capacity is able to increase to keep those big customers happy, so that you're providing a limit to them that is relevant, and we don't end up in the kind of I describe it as the BP problem, where before the Macondo, BP said, in fact, we ended up having Tony Hayward speaking at a conference we organised after the Deepwater Horizon Macondo loss, and obviously inevitably was asked, why didn't you buy more insurance, or any insurance? And he said, well, you couldn't provide me with anything that was relevant. I had a $40 billion loss, and you would have given me $1 billion, and we'd probably still be arguing about it now. We'd be in the High Court and Supreme Court, and you probably wouldn't have paid, is what he said.
It's a reputation issue for the industry.
Are you, for some of those massive corporates,
I think that's more a challenge. I think we can, and I think the limits are getting there. I would suspect, if not this year, certainly next year, we'll see $1 billion cyber tower. And I think, whilst that isn't as much insurance as the large corporates are buying in some of their other towers, it's getting to a point where it's relevant. Can we do that? We looked at, I think in general about 50% on average, we think, of the Fortune 500 are buying cyber insurance. So that's where the penetration is. And I think the reason they're buying it isn't necessarily this idea that, I think there's a D&O exposure here. Not only understanding a risk, it's going through the process. And then if you know that there's a risk transfer option available, then deciding not to transfer it has its own challenges. And I think that is also a driver of that. On the other side of it, on the SME side, I think the penetration is far lower than that. I mean, there are millions of SMEs coming from sort of one-man home-based businesses all the way through to 20, 30 employees, that sort of scale. Globally, there are millions of businesses, and I rather suspect probably only a couple of 100,000, maybe more, are buying cyber insurance. So the penetration is significantly lower on that side than it probably should be.
Last thing on the kind of capacity question is been a lot of talk about ILS, and you're sitting in a global organisation that runs capital sort of all the way from the original risk all the way up to the capital markets with ILS within the Axis organisation. We've had a lot of talk about getting ILS involved in cyber cat, perhaps. Is that just talk, or is there anything really likely to happen?
Yeah, well, we've seen some. We've seen certainly the green shoots of that particular issue. I think it's a relevant thing. It also gives that reinsurance capability and capacity for those tail events as well. The challenge is, to my mind, is defining the return period. There is a liability element to cyber, and consequently the tail is slightly longer than ILS would typically like. And so that's always been the issue. However, if you come back to the binary events, did one of the cloud service providers fail or not fail, then the ability to suddenly go, actually, whether it's a parametric or whether it's something else, you can probably come up with something and be creative and do the right thing. And that's, I think, the area we're probably going to see the first genuine ability to transfer some of that risk.
Right, well, that makes a lot of sense to me. We've been speaking about cyber being such a dynamic risk. I go to a lot of insurtech events. We talk about people with sort of black boxes in their cars and telematics, and it occurred to me, if cyber's really dynamic, could it lend itself to dynamic pricing of some kind of description?
I love that. I think I genuinely think that
but
must be.
Would anyone buy it? That's the question.
I think the problem is, would we be able to run the credit control to make sure that the pricing was as dynamic as it could be? If you take that to its fullest event, just the sheer practicalities, you've put this system in place or you've patched your system, thus your insurance should be cheaper. Just running that, is one of the limitations. But if we excuse that problem, I think fundamentally the really exciting thing about this data is how do we turn data into information and information to insight. That's what we're constantly trying to do. That's sort of the classic triangle of the events. With the more data we have, the more insight we've got, we can potentially generate. The challenge is, and I think this is the issue with cyber, and we've started getting there earlier, I think, is this idea that yesterday's events aren't necessarily totally predictive of tomorrow's events. Because what we're not doing is looking at the null results. We have insurers that have 3.5 billion attacks a day. If you define attack as some form of whether it's a spam email or some form of potential intrusion into their system, we only then score them when they have the one that matters. Actually, the 3.5 billion, times 365 is really interesting. Why aren't those becoming actual events and causing the catastrophe? And that's the data I'd love to capture and unpack better. And I think that's where the systems have got to go.
Right, okay. I want to talk about cyber seems to me to be one of the classes of business that is as close to a service as insurance gets, particularly with things like the breach response and other things. And also that service of sort of helping with risk management where where you, perhaps a lot of carriers again are acquiring proprietary capabilities in the sort of threat assessment and understanding of the client's risk and helping them solve their problems before they become insurance problems, and that being part of the package. Do you see that as something that's just going to continue and it will end up sort of people will just sort of say, I've got my cyber. But you become embedded in someone's organisation to the point where you do their insurance, but you're really doing a ton of risk management on top.
I'd love to see that, and I think there's a real value there. And again, it comes back to the value we as an industry add. What we should be there is to manage risk in a broader sense, and this is a really interesting risk because the client's learning about it as we go. The industry is changing. The inherent nature of ones and noughts controlling everything we're doing is changing, and thus there's a real idea that actually we're on the same journey along the value chain, us and the clients we're insuring. And so actually, we have the advantage. We have tens of thousands of clients versus one client, and so we can actually give huge amounts of insight back, huge amounts of what good hygiene factors look like, good behaviours look like, and we're doing lots of investment. And I think it's understand that entire value chain is really important to me. So we sort of split that really into, I suppose, 6 fundamental factors. First, then, education. I mean, just purely education. We talked about the courses and the thousands of people we've had through that, but it's also just unpacking the risk in a more general sense. Secondly, it's understanding what does genuine good behaviour look like. And we currently have a fantastic project we do with the University of Oxford, the Global Cybersecurity Capacity Centre there, and I think they do an amazing job. And we sponsor sort of 4 postdocs and the time of 2 professors specifically looking at this risk. And I think they do an amazing. We've published a few white papers with them. And we're going to continue doing so. That's a great project, and it's looking at what we call cyber value at risk. And if the value at risk, or CYVAR, well, probably not to use too many, TLAs, but I think you look at the value at risk and what compensatory controls could be in place. There's a really good project there. So what does a good organisation do? Then the real challenge is that's all very well, but how do organisations guard the guards? So what is the second and third line of defence doing?
So you're talking about a world in which a company might actually state what its cyber value at risk might estimate it to be, a bit, in the way that a bank or an investment vehicle would talk at its total value at risk, for the stock market crash or something, and there might even become actually publicly available data in an annual report or something.
It would make logical sense, is actually to understand how this risk is stated, faced, and thus what compensatory controls are relevant to that particular type of value as well. So not all values are created equal. As you say, some of it's the fundamental idea of a stock market crash or reputational risk, physical risk. Come back to the enterprise risk issue we were talking about earlier, the operational aspect of that. So different risks for different organizations, different single points of failure for different organizations, and thus different organizations need to value those differently. So they need different compensatory controls. It's not all just updating the system and pressing yes on that key on the when it comes up, do you want to update your antivirus software? Sometimes it's having 2 supply chains or 2, so we need to assess this differently. But I think you're absolutely right in the logical sense. If people are stating it, then we can actually look at what the downside is. And then it comes back to limits as well. Then the market can say, well, that's the average limit we need to transfer. So it's a mutually beneficial process.
Again, on this sort of automatic, we've got Lloyd's, we're sitting just opposite Lloyd's, Lloyd's Future at Lloyd's, Blueprint One and all that stuff. Are you excited about some of those possibilities of sort of automatic underwriting? And do you think, would you see cyber as being obviously being far more technologically advanced than other sectors of the marketplace? Do you think again it's ripe to be the sort of the player that would adopt automatic, almost or semi-automatic underwriting quicker than any other part of the subscription market?
I think the challenge is making sure we monetize the lead investment people are making, and that's always been the challenge with this idea of the lead following the automation of the market. We have put huge amounts of investment, huge amounts of process into understanding this entire value chain and investing on different projects on every part of that value chain. The challenge is, in an automated function, can you make sure you're actually selecting the risk using that information you've generated? I think you probably should be able to and can, and thus I think there's the massive potential for what's been done here. Particularly in the London market with that process, and we're actually genuinely excited about it. I think lead follows what we've always done. I just think there are some, as we know, steps that need to be taken to define what that really looks like.
Something I want to ask about is we spend a lot of time writing and talking about casualty. It's very front of mind at the moment. You're sitting within casualty. We've got anecdotal evidence of certainly a questioning of the solidity of casualty reserves, particularly in the US. We've got price action there. How are cyber reserves sort of, now that you've got a certain sense of maturity, you've got some big losses through the system, some of them are very mature. How are they bearing up? How do actuaries sort of feel when they look at the triangles of your cyber performance?
Obviously, can't specifically mention
No,
not as a reserving actuary myself, but I do think
as a leader,
I think what's really important, Mark, is to remember. This is we talked about this earlier. This idea, this uncomfortable relationship between first and third party in cyber. Most of the time, whilst we have a challenge, what we call time to discovery, there has been a hack. Knowing where that information has gone is often surprisingly long. The period between payload leaving and people noticing payload has left. That window is increasingly coming down, and a sort of a decreasing window, which is great. So. Typically, one of the nice things, certainly when we're looking at reserving, IBNR, those sort of factors, is actually, in most instances, we're paying first-party type losses in terms of their relatively short tail. That most of them are actually the cost of notifying the population. So the per-record cost of doing so. So actually, there's a little bit more consistency. We don't have the underlying pressures that some of the other elements of the liability and casualty market face.
Okay, and how is the sort of we've had a few high-profile cases where from looking from the outside it would look as if plaintiff lawyers have tried to sort of ram a loss through a policy that perhaps shouldn't really have responded in a cyber or was not intended to be a cyber case. Do you think we're getting a better definition and better? Are we getting to a point where some of these these cases, your test cases, are starting to define what is a cyber loss and what isn't a cyberable loss better? Are you being more comfortable with all that kind of stuff?
I think, again, a lot of those are not necessarily the problem of the cyber market. The cyber market, by definition, has always covered cyber losses. The challenge we're obviously having is in the broader market. I think this is where you talked earlier, the regulators have actually had a really positive impact here. They've been pretty clear about what they're saying in terms of if you're taking on risk and you are not definitively including something, then, you may be accidentally including it. So, so be clear about whether you're including it or excluding it. If you are including it, actually, to make it fully affirmative, you also have to do something else, which is price for it. So, that's the challenge. And so I think this idea of moving from non-affirmative or silent to affirmative really carries these two functions, which is be clear about the inclusion or exclusion. If you're including, price for it.
Just a quick yes/no on that. Then you spoke earlier about perhaps the birth of cyber was it was sort of top-down, regulatory-led. With that legislation. Do you think sort of black or white? Do you think it's going to be the regulators, the sort of the prudential regulators, they're going to say, look, guys, sort yourselves out, and you've got a deadline to do it, or do you think the industry will sort itself out?
I'd rather think the industry is capable of sorting itself out, and I think maybe, luckily enough, with a slightly following wind, we have a slightly hardening market. I mean, I think we think it's probably better than that. What's been great is actually as that's happening, people are not necessarily tucking away issues; they're actually using this as the opportunity to do the right thing as well. The challenge is we're still really waiting for the big treaty reinsurers. They're the ones who have probably the lever to pull most. Enforcing an exclusion in a fundamental treaty would probably focus minds better.
It comes to the sort of Y2K moment.
Yeah, I think that's fair enough. And again, as I say, that market comes back, and this is the point: is that most markets actually within the insurance industry come from exclusions. That's how they came about. The political risk of the war market, fundamentally the same thing. If you look at, I think the political risk market came from sort of confiscations of vessels in Jakarta in sort of the 60s and 70s. I mean, these are markets that evolved because the risk is noticed and it wasn't naturally either covered or it suddenly became excluded somewhere else. The same thing is, the cyber market. I do think we've got to be careful though, and sort of not beat ourselves up too much. I mean, the Institute Hold Clause has been around for 300 years, and they can't decide whether piracy is a peril of the sea or a war peril. So we've come a long way in a very short time as a cyber market. We've come a long way as a very short time in understanding this risk. I mean, it literally probably does go. I mean, obviously it's pre-Y2K, but Y2K is a good watershed for this market, and that was only 20 years ago. So it's a long way in a short time, but we've still got a long way to go.
One last question would be, we're sitting in London. Is London the capital of cyber innovation, or are there other places we should be looking?
I think London has a very, very happy coincidence in the fact that a lot of really strong cyber underwriting teams have been here for a while. There's a lot of people who've been doing cyber here in London for a while. And we have that classic clustering effect where, the beauty of the London insurance market is it's a small market within 500 metres of each other. And thus everyone, the ability to innovate quickly, effectively is driven. But I'm very lucky. I wear a global hat. I sort of spend as much time outside of London as in London. And I will be absolutely clear, the US cyber market is brilliantly innovative, is doing great things, particularly maybe at the smaller end. And we're still starting to see a real growth in the market in Asia, in Australasia, and some really good underwriting talent emerging and some really good innovation in terms of the product. Because as we move away from these big three, financial institutions, retail and healthcare, to manufacturing, to physical loss, physical damage following cyber event, to broader types of coverage, then we're going to have to see innovation. As new buyers are buying it, wanting to transfer new risks, then fantastically the market is reacting to that. It's really positive.
Well, I think we're coming near to the end of our allotted time, and also I think I've asked you all the questions I want to ask, but I need to ask you, is there anything that you think we should have touched upon that we haven't yet before we go?
For me, I think the classic, I just want to sort of get across, you probably can tell, I'm absolutely passionate about what we do, and I've loved, A, being part of the insurance industry, and B, being able to look at a risk and understand it and transfer it and deliver a great service for our clients. I'm really proud of actually what we do and actually the fact we follow through on the contractual obligations we create in delivering that service. But I do also think it's really important to remember the reason we sort of see that as part of the insurance industry is there are more points of parity between what we're doing than there are points of difference. At the end of the day, it's an insurance contract of risk transfer. The clients have a risk. We're understanding that risk. We're evaluating what the price for transferring that risk, and we're offering some transfer, so which is the same as we do everywhere else in the industry. I think we sort of sometimes focus on the sort of the innovative and those cyber guys. What the reality is actually we're doing what we should be doing, and we're focusing on what we should be focusing on, and long may it last. And I think that's a really important point to make.
Yeah, people they pay premiums and they get the losses paid, right?
Yeah, it's just, and thus we should be doing the social value of what we do. People understand their risk. They're willing to transfer it. We're willing to take that risk.
Well, Dan, thanks so much for giving some of your valuable time today. It's been fascinating. I'll make sure I'll book time in your diary to catch up with you again, at a time in the future. But thanks very, very much.
Thank you, Mark. Thank you so much.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.